Hey, good afternoon, everyone. My name is Jason Love, and I'll be your presenter here today. Again, thank you very much for joining us in here today. Before we get started here, I'm going to talk to you educationally first here today. I'm not going to, sometimes you come on these things and there's some sales that go on at the end, and I'm not going to be doing that with you today. My sole focus here today is to show you some things that worked for me. And really, it revolves around your risk and money management and some of that kind of stuff. I'm not going to get real deep into numbers and things like that, but I'm going to share with you some things that I believe may be eye opening for you, right? And so we're going to go through that process here today. Before we get started, can I just get a quick kind of a location check? You mind telling me where you're located? I like to know, are most of our traders here from the US? Or are we all from different parts of the world? Okay, Sam from California, thanks for that. Anybody else want to just kind of, all right, Canada, very cool. In fact, that's funny. We're going to talk a little bit here, trader, about uh, before I started day trading, and we're going to have been running the oil trading group here. I will have run this thing. It's kind of hard for me to believe. I will have been doing this now in front of a live audience for almost 10 years. It'll be 10 years in October. Before I did that, I worked for a travel company. Speaking of Canada, I worked for the world's largest franchised based travel company, and that was called Uniglobe, and they were based out of Vancouver. Anyway, you made me think of that when you said you're from Canada. Canada is one of my favorite places. Vancouver is one of my favorite cities in the world. It's one of the most beautiful cities in the world. In fact, um, the guy that started Uniglobe Travel is what this place was called. Um, you know, migrated to Canada from England. His dad was in. His dad was actually a U-boat captain in World War II, and when he passed away in the war, uh, his mom married an English officer. They moved to England. Eventually, he made his way over to Canada, and he had the story he tells is really funny. He was going to drive a car from the east coast of Canada to the west coast of Canada, and he ended up landing in Vancouver, and he had his wife and his kid, and a few bucks in his pocket, and he turned it into the world's single largest franchisee operation. He also owns Century 21 Canada, the rights to Century 21 Canada, and what else did they do? They have Century 21. There's a mortgage company that they do. Anyway, he's on the Canadian Forbes most wealthy list, and man, they are some super good people. Anyway, every time, and I'm very fond of that, and of those folks. The Charlwoods was their name, and they're very good people. Anyway, talking about Canada, that's kind of where that was. We've got Atlanta, Connecticut, Texas. All right, Z, I'm in Texas too. I'm in North Texas. Probably hot today. There's a Singapore. That's awesome. Let's see. Virginia Beach. That's where, and I'm going to show you here in a few minutes. I went to Sven is from Scotland. Let's see, Virginia Beach trader. That's where I went to A school when I got out of boot camp in the Navy. I went to A school in Virginia Beach. Actually, I think it's called Dam Neck is where it is. So again, we've got McKinney, Texas. All right, John, you know where South Lake, Texas is? That's where I'm located, is in South Lake, Texas. So we're almost neighbors. New Jersey, and let's see what else. Connecticut, a couple of Connecticut's. And yeah, that's awesome. So Scotland, that's awesome. Very cool. Scotland is very cool. Hey, hello from Utah. One of my favorite trips I did with the buddy, several of our buddies one year, is we went up into Moab and that kind of thing. That was one of our best trips there in Utah. Plus, I have a buddy that lives up in Utah as well. So, all right. So we've got people coming in, and hey, good morning, Faye from Denver. It's good to see you. All right. So here's the deal. A lot of times you come to these things, and these webinars really, now they're online, but they used to be those seminars you'd go to at the hotel. I'm showing my age a little bit here. You'd go to one of those hotels where they would show you a webinar, and then as you left, this presentation, there was a table at the back, right? And they would have books and pamphlets, and they would try to sell you their product and that kind of stuff. Well, you're in luck here today. I'm not going to do that with you. I'm not going to try to sell you anything today. I am going to do something at the very end. I'm going to offer you the ability to come into our trade room and take a look around for a free trial. But I'm not going to literally not going to be selling you anything today. All I want to do today is I want to show you something that I think may be eye-opening. It may not be, right? But you know, it is what it is. But I think I'm going to show you something I think you'll find interesting at a minimum and maybe eye-opening at a maximum. And so we're going to go through this presentation here. I'm going to get started in about 2 minutes. And then basically, I'm just here to educate you, provide you with some education today, and have you maybe look at things just a little bit differently than maybe you would otherwise, right? And that's going to be my agenda here today. So we're just going to relax together. Like I said, I'm not trying to sell you anything today. Not that that's a bad thing, right? Because people want stuff. But really today, all I really want to do is just provide you with a little bit of knowledge and information that I've gathered along the way. Like I said, I'll have run a trade room and been doing this in front of a live audience for what will be 10 years in October. And so along the way, I've done a little bit of everything, right? As you can imagine in trading. I've been trading 15 years. I had the good fortune of being mentored by a guy who traded on the floor of the S&P pits for 30 years, right? And so I had a really good mentor in that regard, right? And so there are things along the way. There's a lot of people like me out there, you know, people who provide education and information and those kinds of things. And whether you buy into every single thing that someone says, when you come to something like this, you do take away a little bit of something. But you go, yeah, you know what? I didn't agree with all of that, but I did agree with this one thing. And that is what you do to develop your toolbox, right? So you're going to be taking these tools, putting them in your toolbox, and moving on. And hopefully you'll join us for our free trial, come into our trade room, see how we operate on a day-to-day basis. We'll talk about that at the very end of this. We'll talk about that at the end of this. Manny, welcome. It's good to have you from Mooresville, North Carolina. Don't know much about North Carolina, but from what I hear, it's a beautiful place. All right, so let's get started. So we're going to talk. My title of my presentation here today is "Learn to Trade Like a Casino," and we're going to talk about defining your statistical advantage over the market. All right, so before we get started here, I'm going to give you a little bit of introduction to who I am. Again, my name is Jason Love, and I'm the founder and lead trader here at the Oil Trading Group. And that is me back in 1987 with the hockey haircut, right? What is it? Business in the front and party in the back, my nice mullet. You know, we were talking about Canada a minute ago. And but there I am, graduating from high school with a nice mullet. There's me a few months later. As I graduated from boot camp in the United States Navy. I was a combat veteran of Desert Storm, so I was in, that gives you a little bit of a sense of my age. I was 87, graduated, got out of boot camp in 88, and was on the ship that launched the first missile in Operation Desert Storm back in 1991. I think that was right, 90 or 91. I think it was late 90, 91. I can't remember. It's been so long ago, right? I held a top secret security clearance while in the military and was designated the leader of our platoon, if you will, our squad in boot camp. There I am a few years later, shortly years later. Again, as I've gone through, and not to get all Shirley MacLaine on you, but to give you just a little bit of past life stuff. I was the vice president of a 300-seat call center. We just kind of talked about that at Uniglobe Travel. I was in this unique position. It was a travel agency, and we provided support to all these agencies located around the world. And when 9/11 happened, as you remember, travel shut down. In fact, people became very nervous about traveling anywhere. And so I was in this unique position of firing myself, right, where I had to let myself go as we closed this call center down. Now, I had an opportunity to move out to Los Angeles and become the president of Uniglobe Travel USA. I actually turned it down because my son and his mom were going to move back to Texas. And of course, I wanted to be a good dad to my son. And so I ended up moving back to Texas. And that's where I left that Uniglobe Travel USA. But what it did is it taught me running a call center, being a vice president of a call center of 300 people really gave me a sense of course, the military does as well, organization and what it takes to plan and map out things and stuff like that. We're going to talk a little bit about that as we move through it here. Back in 2010, I founded the Oil Trading Group as I was a little bit like some of you, right? Where I was out there trying to find education partners and looking for things to do. And I was trading and I had this mentor, but I wanted to be in a place where there was some chat going on and camaraderie and that kind of stuff. And you know, what I found out there and back in 2010 was there was a bunch of junk out there. It just really wasn't very good. Right. And so I thought, you know, my organizational skills, I can talk okay. I'm a decent trader. Let me go out there and start this chat room. And it's kind of evolved over the course of the years. And again, like I said, it'll be 10 years in October to what we do here today. I have participated as a twice weekly Squawk Radio guest at Top Step Trader. We have 200 plus active Trader Room members, and we are in the process right now finalizing a really cool beta test that if you're not familiar with who Top Step Trader is, I'll talk to you about them in just a few minutes, but they are a prop firm, somebody that will provide you with trading capital if you can pass their, you know, trading examinations. And so if you may know this, you may not know this, but there's a two-step process that they go through. Well, we just almost completed our last day for this will be Thursday, a beta test where they allowed our group to be the test for people to go straight from step one into step two automatically without having to pass that phase one, right? They said that they basically have told our group that the education you provide and the things like that you get at the Oil Trading Group is enough for you to advance directly into step two. So we've had some really positive results with that beta test that we did. So here's what I'm going to talk to you about today. Is day trading considered gambling? We're going to talk about a trading edge. We're going to talk about, I'm going to show you how a 35% win rate is better than a 60% win rate. Cue the record scratch, right? What does he mean by that? We're going to talk about that here in a few minutes. We're going to talk about the quote unquote Holy Grail. And if you come on these things, people always talk about Holy Grail or whatever. And then we're going to talk about a little bit about the OTG success formula. So when I first started doing this, right? And I said, okay, I'm gonna be this entrepreneur. I'm gonna get into some real estate. I'm gonna be this day trader. I was in a corporate world. I had been a director level guy at a Fortune 500 company. Then I became a vice president at Uniglobe Travel. We just talked about that. So I'd had some success in this corporate life. And now I'm going to day trade, right? Because 9/11 happened, and I said to myself, as some of you may be doing now with the COVID-19 stuff, I don't want to ever be in a position again where I have to rely on someone else for my income. Okay. And so I said, I'm going to do this, a little bit of this real estate, and then I'm going to day trade. And then I had this mentor that was kind of teaching me the ropes and things of that nature. But then you'd go to the parties, right? And you guys do this too. You'd go to Thanksgiving, you'd go to a cocktail party, you'd go to happy hour with your friends or whatever, and they ask you what you're doing. Okay, what are you doing, Jason? I know you're not at Uniglobe anymore. What are you doing? Well, I'm day trading. Dun dun dun, right? And all of a sudden, everybody looks at you like you got six heads, and they start going, well, isn't that gambling? And I hear nobody is ever find success doing that, and blah blah. But you know the routine, right? And so I used to get annoyed with that when people would ask me, is day trading gambling? And I would try to come up with an answer that was like, oh no, it's not gambling, right? It's not, it's this and that, it's education and probabilities and all that kind of stuff. Well, it finally dawned on me that, well, let me just read you the definition. This is off of Webster's website, right? Gambling, to play a game for money or property, or to bet on an uncertain outcome, right? Well, That's gambling, right? I mean, there's no certainty to when you know, play hand of cards or roulette wheel or whatever else you do, bet on a football game, whatever you do, that's gambling, right? That is betting on an uncertain outcome. And you know what? Trading is the same thing. When you enter into a trade, regardless of all the back testing and forward testing and all the things that you've done, there are only two outcomes to the trade. It either works or it doesn't. Even if you have an 80% win rate, there's 20% of the time that it doesn't work. 20% of the time it won't work. And how do you know that you're in that 20%? So you really are gambling. So according to Webster's dictionary, yes, trading is a type of gambling. However, the main difference between gambling and trading is this. When you are gambling at a casino, the casino controls the statistical advantage. As traders, we can control the statistical advantage, right? So let's do this. And let's talk about what the casino's advantage is here. All right, so this is a standard North American roulette wheel, right? There are 18 black squares, there are 18 red squares, and there are 2 green squares, right? So you see the and I say squares, you know, they're the slots on the table. So you see that 0 green at the bottom and the double green at the top. That gives you 38 chances to win, right? So there's 38 chances to win, 18 red, 18 black, and 2 of the green squares. Now, if you were going to bet red or black, okay, so you're going to gamble red or black. You're going to say, well, I'm going to put it on this black 8 that you see up here, right here. All right, so I'm going to put my money on that. You have a 47.3% chance to win, right? You have 18 black, 18 red, and then there are those 2 green squares, right? So if it's not quite 50-50, it is 47.3 when you incorporate those 2 green squares. The casino's chance to win is 20 divided by 38, or 52.7%. The reason they have that advantage is because they win on those 2 green squares, right? So those 2 green squares, or those 2 green slots, give the casino their statistical advantage. That is a statistical advantage of 5.4%. Or in other words, when $1 million is bet in the casino, and you say, gosh, that's a lot of money. It is, but it can go very quickly, right? That can add up very quickly with all those spins and all those tables. The casino has an advantage of 5.4% or $54,000 on $1 million that is bet. All right, so trading test here, right? Real quick, trading test. Trade number 1, winner or loser. Trade number 2, winner or loser. Well, as day traders, we don't know the difference between a winning trade and a losing trade until either it A, hits our stop, or B, hits our target. So theoretically, this is a 50-50 chance of winning, right? Well, not so fast, right? Not so fast. When you bet at a casino, you risk $1 to make $1. However, because of emotions, traders typically tend to lose more when they lose than win when they win. And so as a result, what appears to be a 1-to-1 reward to risk ratio is actually much worse. Now, I'm going to give you an example here. And I told you I've been doing this for nearly 10 years, right? I've done this and I've had this, the conversation I'm about to have with you, I've had this conversation with, I'm going to say dozens, but I bet it's closer to hundreds of traders as we've gone through over the course of the years, right? So a trader that trades 2 lots enters a trade. By the way, we are the oil trading group, so I'm going to use the CL oil as the example here. By the way, this will apply to any other instrument you're looking at, but for the sake of this discussion, 1 tick equals $10 on the crude oil CL, right? So when the trade goes in their favor, okay, on a trader that's traded 2 lots, they take 1 lot off at 10 ticks and they let the other lot run. Okay, so I get that a lot in my room. So Jason, the trade went 20 ticks and came back and pulled you out at break even on 2 lots. Why didn't you take 1 off at 10 ticks and let the other one run? I always do that. Okay, that's great. But why didn't you do it, Jason? Well, let's talk about it. And so again, like I said, I've had this conversation, I'm going to tell you dozens of times, but I believe it's probably closer to hundreds of times, right? So my question always back to that person is, that's cool. You took one off at 10 ticks, right? And you let the other one run. How far on average does that second contract run? And you know what the answer is? It's a lot of, well, uh, I'm not sure, right? I get a lot of that. So let's talk about what the options are, okay? So some traders take one off at 10 ticks and they move their stop to break even, okay? So if it comes back, takes them out of break even, they lose a little commission, so maybe they're 9 ticks positive. Some traders will have a 2-to-1 target and they'll leave their stop at the original place. Some traders will say if they had a 12 tick stop, they'll move it to break even -9, take one off at 10 ticks and let that one come all the way back. Some traders will move it to +5. Some traders will take a 2-to-1 reward to risk ratio and they'll have a very tight stop in behind. Anyway, you get the idea. There are literally an infinite number of variables, right? That you could do that. Take one off at 9 and move your stop to 8. There's an infinite number of variables that go into that. However, since I've been doing this, and again, I've done this for nearly 10 years, the average ticks of the second lot over time is about 6 ticks. So you take one off at 10, and when you mash all those different variations in together, that average lot goes off at about 6 ticks. So then the next question is, where is your stop? Well, CL traders will have a stop somewhere between 12 to 15 to 20 ticks. I've seen this micro scalpers with 2 tick stops, which again, that just gets chopped up in noise a lot of times, but I've seen that. And then I've seen some guys that say, look, I'm going to have a 40, 50 tick stop, and I'm either going to be right or I'm wrong, and then I'm done on the day, right? But generally speaking, 12 to 15 to 20 ticks is about what I see on the CL. So when a trade wins, the trader wins $160. One lot off at 10 ticks at $10 per lot, it's $100. One lot off at 6 ticks at $10 per lot, that's $60. So that's $160 when they win. The stop loss, if we use the low end of the ratio at 12 to 15 to 20 ticks, the low end of that stop loss average is $240. That's 12 ticks times 2 lots. So again, when this trader enters the trade, he is risking $240 to make $160. In other words, for every dollar put at risk, he's being rewarded 67 cents. So what appears on the surface to be a 50-50 proposition is actually much worse than that, because this trader is losing more when they lose than wins when he is winning, right? And so we talked about that a minute ago. If you were just flipping a coin or you were playing the roulette wheel, you went bet $1 to win $1. And so, but when you get into that initial trade, right, and you don't know if it's going to win or lose, not only is it a 50-50 proposition, but you're also in a very upside down position in terms of reward to risk, right? You're already in an upside down position, right? So trading's hard enough without putting yourself in an upside down position like that. So what I'm going to show you today is hard, okay? What I'm going to show you today is not easy. It's a learned skill, right? It's like that first beer you ever had, right? There's very few of us that went, man, that's delicious. I'll drink that all the time, right? That first beer is kind of bitter and maybe had an aftertaste, and eventually, as you went on, you became more accustomed to it, and then you kind of grew to like it, right? But what I'm going to show you today is hard, and it's a bit of an acquired taste. But you know what? Losing weight is hard, right? But so are the health ramifications of not losing that weight, those few extra pounds, or being overweight. Quitting smoking is hard, right? But so is lung cancer. If you have lung cancer, that's hard, right? If quit drinking is hard, and we all know somebody that may have a problem with their alcohol and the way they behave or the way it impacts their life. And so you say, just quit. Well, we know that that person has a difficult time quitting because it is hard, right? So finding your edge and trading with it is also hard. But here's my question to you. If they're both things that are hard to do, quit drinking, stop smoking, you know, doing a better reward to risk ratio. If all of these things are hard to do and the ramifications of not doing them are hard to do, so in other words, if they're both hard, why not let's pick the hard that is best for us, right? Let's work on picking the hard that's in our best interest. All right, so this is straight off Investopedia.com. If you don't know who they are, go visit their website. They're good, good trading resource for definitions of things and stuff like that. Investopedia defines a trading edge as a technique, observation, or approach that creates a cash advantage over other market players. It doesn't have to be elaborate to fulfill its purpose. Anything that adds a few points to the winning side of an equation builds an edge that lasts a lifetime. All right, so you've seen kind of a war, military type of presentation or angle to this today. And Sun Tzu in his book, The Art of War, says victorious warriors win first and then go to war, while defeated warriors go to war first and then seek to win. And so this reminds me, and the reason I put this in here is because we probably have all done this. At least 90% of us in here will have done this, and maybe a greater percentage. You get a laptop, you get a book, you get some training from an educator, and you put some money in your account, and you immediately go to war. And what happens? Right? Defeated warriors go to war first and then seek to win. And then you blow out your account. And then you start to do things like you're doing here today, where you go listen to see if there's something valuable that I'm presenting in here to you today, right? Victorious warriors, they plan first, they get their plan together, they understand what they're doing, and then they go to war, right? And that's what's being discussed here is in Sun Tzu's book, Art of War, victorious warriors win first and then go to war, while defeated warriors go to war first and then seek to win. So let's talk about the power psychologically of a statistical advantage. All right. So what you're looking at here is a screenshot of a college football game. And with any luck, we'll have some college football this year, but that may not happen given the current environment. But let's just talk about this screenshot specifically. If you are familiar with college football, then you'll recognize these two teams. The team in blue with the yellow pants is the University of Michigan. The team in white with the green helmet is Michigan State Spartans. Okay, so they are the two main schools in the state of Michigan, and they play a rivalry game every year. Now, if you're in Europe, and this might be your favorite derby, right, of your favorite football clubs. But for the sake of this example, we're going to talk about these two teams in the state of Michigan. They play once a year, and it is a big rivalry. So if you are a graduate of one of these schools, or you graduated, if you're a graduate of one of these schools, or you grew up a fan of one of these schools, this particular game gives you bragging rights for the entire season, right? And so normally that team with the blue top and the yellow pants is the better team. Under most circumstances, they are the better team. But not this year. If you look down there in the bottom right-hand corner of the screen, you'll see it says Michigan State has a number 7 next to their name, and Michigan has a number 12 next to their name, right? And so this year, if you're a Michigan State graduate, this was going to be your year. This is the year that you're going to finally defeat your arch nemesis, your rival, the University of Michigan. So you sit down on the couch, you get your queso, your favorite adult beverage, you're about to watch the game, and your wife or significant other comes up to you and says, not so fast. Remember, we had this thing we had to go do today, whatever that thing is. And man, you're disappointed. You'd forgotten all about it. You were ready to watch the game, but we know the saying, right? Happy wife, happy life. And so begrudgingly, you get off the couch, you put your favorite beverage in the fridge, you put your queso in the microwave. You're gonna have to warm it up later, and off you go to do your honeydews, right? So off you go out to do that. Now you recorded the game, and so you're gonna watch it when you get back home, okay? So you're out and about, you're doing your thing, and you've done really well to try to avoid the score, but at the end of the day, somebody tells you that your team won. The University of Michigan lost, Michigan State Spartans won. Your team, the team you've been rooting for and has not done well in all of these years before, actually won the game. And while you're excited, you're a little disappointed. You're a little disappointed that you don't get to watch the game in person, but you're really excited that your team won. So you do all your honeydews, you come home and you sit down on the couch, you get your cold beverage, and you get your queso and your chips, and you're ready to go. Now, there is a lot less stress on you, right? And if you're a football fan or a fan of sports, you know that you will live and die with your team on every kick of the football, pass of the football, swing of the bat, basketball shot. You live and die with everything your team does. Now, your team is favored this year. You are going to win this game, or you are not you're going to, but well, you know you're going to win the game, but your team is favored, and you're really excited about the fact that you know that your team won. Ball gets kicked off. Okay. Michigan runs it back for a touchdown. You're down 7-0. No big deal. No big deal. Normally that would really stress you out. So you get to the end of the first quarter, you're down. You go into the end of the second quarter, going into halftime, your team is still down and they don't look very good. You go into the third quarter, team doesn't look very good. You're still down. And now you're saying to yourself, did I hear it right? I mean, we're down all game here. We're not looking very good. How is it that we're going to come back and win? You go to the fourth quarter. Now, I don't know if you can see this very well on the screen. There is 1 second left in the game. Fourth quarter, 1 second left in the game, right? Michigan State, the team in white, is celebrating, okay? Because you knew the outcome of the game, you stayed all the way to the end to watch it. But if you don't know the outcome and you don't know your statistical advantage and the psychology of that statistical advantage, there might have been 10 seconds left. By the way, what happened on this play was Michigan snapped the ball back to their punter. The punter muffed it, fumbled it around. Michigan State picks it up and runs into the end zone. If you didn't know that your team was going to win, you wouldn't have stuck around for the whole game, right? You would have turned it off and moved on. Sound familiar? Right? You would have turned it off and moved on. But because you knew the final score, you didn't know how it was going to get there, but you knew the final of the game is your team's going to win. All you knew is that, man, this is going to be one hell of a comeback because I know they win today. That's the psychology of a statistical advantage. So again, when you have a statistical edge, you know the outcome before it happens, right? You have a series of probabilities. Remember, victorious warriors win first and then go to war, while defeated warriors go to war first and then seek to win. If you didn't have this psychological advantage, if you didn't know what the score or the outcome of the game was going to be before you sat down, you wouldn't have stayed for the whole game. You would have gotten out before you got paid off, right? You would have finished before you knew the finishing, before you saw the end of the game, and you would have missed that really cool payoff at the end. All right, so I'm going to show you a few things here really quickly. Got to run through this real quick. I won't go through it in great detail. You guys have seen this kind of stuff before, but the U.S. government wants us to let you know that the CFTC and options, the Commodity Futures Trading Commission, futures and options trading has large potential rewards, but also large potential risk. Again, you should seek appropriate advice from your broker or licensed investment advisor before taking any action. The Oil Trading Group, that's us. We do not hold ourselves out as a CTA or commodity trading advisor. So given this representation, all of the information and material provided by us to you here today is for educational purposes only and should not be considered specific investment advice. And then, of course, there is the hypothetical statement that you see on all the different websites. There's a link at the very bottom down here. If you want to screenshot that, you can go to our website and take a look at that information. So remember when I told you what I would show you today would be hard. So one of the things that we do is we provide education and avenues to help people pass prop firm tests. So we've done a number of these with different organizations. We are more closely aligned with Top Step Trader, but we've done Earn to Trade. We had the lady that started Lilu, if you're familiar with them, is a member of our group. And so I'm intimately familiar with how these processes work, right? And so these are just a few samples of trading combines that I have taken in front of a live audience in the past. And so what I'm going to do here, by the way, is I'm going to throw into the main chat window, I'm going to throw a link in here for you, and you'll be able to go through, and this link will take you here. Let me see if I can show you this. And you can go through here and you can dig through some of these additional combines and analysis of things that I've done and in the past. And this is not an all-encompassing list. In fact, we just made it through into a funded trading account in front of our live audience within the last 30 days, right? We were rolling out this step 1 to step 2 automatically thing for Top Step Trader, and we just ran through that and did that with our group here over the course of the last 30 days. So this is not an all-encompassing list. Really, all I want you to kind of focus in on is the win percentage column, right? And so the win percentage here, most of the time it's less than 50%, and in a lot of cases it may be less than 45%, right? The other key to the component to this is the average winning trade. So all of the average winning trades and all the average losing trades, you're averaging about 4-to-1 reward to risk ratio. So what does that mean? Well, it means that the win percentage is going to be lower because your reward to risk is higher, right? If you flip that paradigm, typically speaking, if you take smaller targets, you're going to have a higher win rate, but the reward to risk is not going to be as great. So this is, again, sometimes can be a very difficult thing for people to have to deal with these winning percentages below 50%. That can be a mentally draining or mentally taxing thing for people. So again, like I said to you, what I'm going to show you today is hard, but there's a lot of things that are hard, right? So let's pick the hard that's the best for us. All right. Also, on our website, I did a video where I showed how we went from 0 to funded trader in 15 trading days. There's a video here on our Top Step Trader idea. And again, I'm going to show you some statistics in that video that it's probably one of our most popular trading videos that we had. And I'm going to copy, whoops, I guess I won't do this. I will copy this link in here for you so you can take a look at that. And I'll put that link into the chat window as well. All right. So I'm going to introduce you to something that I call the desktop psychologist. It's really our OTG risk algorithm. And I'm going to show you right now how a 35% win rate is better than a 62% win. I'm going to show you how a 35% win rate trading one lot is better than a 62% win rate trading two lots. All right, so let's set this thing up. So I'm going to bring this out here for you so you can see this. Hopefully you guys can all see this okay. All right, so I'm going to start here. We're going to set this thing up. So basically what this is designed to do, this spreadsheet here, this algorithm, what it's designed to do is to take all of the information that you plug into it and spit out some probabilities. Okay, now this can be what if scenarios. This can be your actual statistics, right? If you have a set of statistics that you track, TraderView or Journal Analytics or some other tracking platform that's out there, if you're tracking your statistics, you could plug them in here to see what your expectation could be on your particular system. But for the sake of this discussion, I'm going to set this up in a very, what I would consider to be a very reasonable type idea, right? And let me explain that here. Let me do something first really quickly. Let me get an online calculator here so I could show you the math as we go through this. So let me get this set up. Let me see if I can find this here. Yeah, this is it. Okay. So I'll do it like this. And we'll make this a little bit smaller. Okay. Whoops. I knew that was going to happen. Hang on a second. I knew I would do that. All right. So this is the online calculator. So again, we're going to start with the $15,000 trading account. That's a pretty normal account for people that I talk to in our trade room. They have $15,000. Some have much more, some have much less, regrettably, which is, by the way, which is one of the reasons why I go through this prop firm stuff with people, right? Because a lot of people come to the dance here, if you will, woefully undercapitalized. But for the sake of this discussion, we're going to use a $15,000 trading account. Now, this is going to run a series of trials or trades. This is not a particular system, and it's not a particular instrument. This is just simply plugging in numbers that are going to be randomly distributed as they might be randomly distributed in a live market. So again, this is not a trading system, right? This is not back testing or forward testing. This is just simply numbers, risk management numbers, as they may occur in a real-time environment. Okay, so remember what we said what the average losing trade or the average stop on the CL was? We said that was $240, right? We go back to earlier when we said one lot, one off at 10 ticks, one at +6, and that was your reward, and then 240 was your risk. So if your risk per trial is $240 and you have a $15,000 trading account, so that's 240 divided by $15,000, okay? Oh, not 150, Jason. Let me try this one more time. 240 divided by $15,000, okay? That gives you a risk of 0.016 per trade, or your risk per trial is 1.6%. Now, automatically, there's something wrong with this, okay? And that something is, if you are going to kind of go by the standard, and there's a lot of discussion on this point right here that I'm going to make, but let's just assume for a minute that we all agree that you don't want to risk more than 2% of your account in a given day, okay? So right now you have one trade where you've risked 1.6%. So if you lose that first trade and you want to trade again, you're now at 3.2%. You already exceeded that risk in a normal day, okay, that you should be doing on your $15,000 account. But be that as it may, that's what your risk parameter is. Now, we're going to assume for a minute when I run this that you're going to have a $5 commission. Now, not every trade, not every place is $5, and you know, there's going to be slippage and all of those kinds of things that are involved. But we're going to assume for a minute that your commission is $5 per trade, okay? So that's going to account for some slippage and commission. And we could bump that number up if we wanted to, but we'll just leave it at that for now. Now, on this particular sheet, you're going to plug in exactly the statistics that we talked about earlier. And those statistics are this. For every trade, okay, that you take, you're going to win $160. And for every trade that you lose, you're going to lose $240. So that gives you a 0.67 reward to risk ratio, okay? So you're going to have a 0.67. So for every dollar you put at risk, you're going to win 67 cents. Make sense? $240 stop, $160 profit. Okay. Now, I told you that I was going to show you how a 62% win rate how that's going to fare with a 62% win rate, okay? Now, when you lose, you're going to lose 1-to-1, meaning that if you're going to risk 240, you're going to lose 240. And now we're going to say that you're going to lose 33% of your trades and you're going to break even on 5%. That gives you a total trades of 100, okay? Now, we'll hit reset and you'll come over here and you'll notice that the initial equity is 15 grand. You had a 62% winning probability and your risk here is $240 on your $15,000 trading account, right? So you see how that works out, right? Now, what's going to happen is it's going to randomly distribute trades, okay? So as you know, when you take a trade, you start the month, you sit down, you start trading, you don't have 6.2 winners in a row, followed by 3.3 losers, followed by followed by half a break-even trade. It doesn't work like that, or whatever, one break-even trade. It's spaced out over the course of 100 trades. There's this, as you know, in reality, that front end may be loaded. You may take 4 losers in a row, okay? And then you get on a really nice winning streak, and then you take a few break-even trades, right? You also know that if you have a 62% win rate, that it's not 62% on the dot every month. Some months, one month might be 67, the other month might be 58, and it may go like that over the course of time. So what this analyzer, this algorithm is doing is it is saying, okay, randomly distribute based on this input that you gave us, randomly distribute all of these numbers as they might occur in a live trading environment with these parameters, okay? And then what it's going to do is it's going to spit out the answer at the bottom of this sheet, meaning the answer, meaning this, that if you take one trade and you win, it's going to add that to your total, and then it's going to go to the next trade. You're going to add it, and if it wins, it's going to add to the next one. Then if it loses, and all the way down for 100 trades as they might occur in a live market. Now, again, it's not a trading system. It's just spacing out the trades as they might occur in a live environment, okay? So hopefully that makes sense. So what I'm going to do now is I've hit start, and we're going to watch these boxes down here at the bottom, okay? So I'm going to click run all trials. All right, so in this case, you had a winning percentage of 61%, okay? 61% win rate. You had a max drawdown of 12%, right? You had a max drawdown of 12%, and your final total here was minus $394. That's what your profit was this month on your 62% win rate at those levels, right? And you can see here how it took all of these trades and began to basically stack them up. You won your first one, you won your second one, you lost your third, you lost your fourth, etc. All right, let's reset it and run it again, okay? Whoops, we want to run all trials, not next trial. We're going to run all trials here. And so on trial number 2, you had a 63% win rate. You had a max drawdown down here at the bottom of, did I not do that right? So hang on a second. You had a profit of 1,182. All right, so let's come down here and take a look at the max drawdown. Your max drawdown here was 8%. Okay, so minus 8% on the max drawdown. All right, so we're going to hit reset, and we're going to hit start and run all trials. We'll do this for the third and final time here. And on this particular idea, you had a win rate of 61%, okay? And you had a max drawdown of 15.2%, and you had a profit of $338. So over the course of 3 months worth of trading, you were positive 1182, you were positive $338, and you were minus 394. Okay, so you had a net profit of $1,126 over 3 months with a win rate of about 61.5%. Okay, that's the way that worked. Now, one of the sphincter tightening moments that you had in this is you had a drawdown of 15.2% of your account in one of the months. Now you recovered from that, but that was the drawdown that you incurred. Now I'm going to change this on you, and I'm going to bring this over here to a 1 lot. Okay, so again, we're going to take a 1 lot with 10 ticks on the CL as a stop, right? So that's $100, and we're going to give this a 15,000, divide that by the $15,000, okay? So $100 is your risk divided by your $15,000 trading account. That's going to give you a risk of 0.0066. All right, so I'm going to come over here and I'm going to type in 0.0066. So again, that gives you a risk per trial of 0.66%. Now, again, if you're not going to lose more than 2% of your trading account on a particular trading day, then you have 3 trades now that you could lose in a row and still be less than that 2%. In the other way we were looking at it, you had a 1.6% on one trade. If you took that second trade, you're already over that lose no more than 2% idea. Now, I'm going to show you here what we're going to look at this, and we're going to hit reset here, and we're going to look at this on a 2.5 to 1 reward to risk ratio. Now, remember what I showed you on those other statistics is that I was averaging about 4 to 1 on my reward to risk ratios, right? I was averaging about 4 to 1. Now, we're going to change this win rate to 35%. We're going to change the break-even rate because the higher, the bigger the target, the more likely it is that you're going to get pulled back out and break even. So we're going to change this break even to 18%. And we're going to change the losing trades here to 47%. Okay. So I'm going to win 35. I'm going to lose or break even on the remaining 65% of my trades. Ugh. Remember what I told you, it's going to be hard, right? This is a hard thing to get your head wrapped around, right? This is what I'm showing you today, not easy necessarily, right? So we're going to hit reset. We're going to come down and take a look. We're going to hit start. I'm risking $100 here, and we're going to watch this down below. We're going to hit run all trials, and let's see what we come up with here. So with a 32% win rate, okay, 32% win rate, and a max drawdown of minus 5.8%, I profited this month $2,700. Now, that's already better than your 3 combined months, right? That's already better, right? So we're going to click OK, but we're going to do it again. We're going to hit start. We're going to hit run all trials. In this particular month, my win rate was at 35%, okay? My max drawdown was minus 4.3%. And my profit was 43.62. Okay, so we'll do it again. We're gonna hit reset, we're gonna hit start, we're gonna hit run all trials. And this time the profit was 30.60 in this 3 months. Your max drawdown rather was 5.5%, and your win rate was also 35%. So in this 3-month tested, your average win rate was 34%, and your profit here was 2,700. I'm just going to round down. 4,300 plus 3,000 was $10,000. Okay, in your 3 months. Now, if I said to you, you're going to have a 35% win rate this month, and for the next 3 months, you would say to me, "Holy crap! See you later." If I said to you, you're going to win $10,000 on a 1 lot, you would say, "Sign me up." It's the same system, right? So now I did this exact same drill that I'm showing you here right now, and I'm going to throw this link into the chat window here, so you can take a look at this spreadsheet here on your own. But I did this exact same drill that I just showed you, and I did that over the course of 6 months. All right, so this is the testing parameters I used here was a 62% win rate with a 2 lot risking $200. So I took the risk down from 240 to 200, and instead of that gave you now, instead of a 0.67 reward to risk, it gave you a 0.8. Okay, and so month number 1 started out at a $15,000 balance, and by the time we got to end of that month, you were net $2,275. We then took that new total and ran it all the way down until you got to the end of month 6, where you're up about $19,000. Okay, and so then at the bottom down here, I took all of those different months and your ending balance, and that we carried it forward here all the way through, and so you could see all 6 months as it went down through the process here, right? So that was that process as it went through for 6 months, using a 62% win rate with a 0.8 to 1 reward to risk ratio. Okay, then I ran it here for a 31% win rate with a 2.5 to 1 reward to risk ratio. the starting balance at $15,000, same methodology all the way to the end of that month with a $30,000. You almost doubled your account with one lot winning 31% of the time. But here's the key, okay? Here's the cool thing. So you go through here and you go down to month 3. Now, by the way, I'm going to go back up here first. We're going to start up here first. Month 3, if I said to you, hey, take your one lot and your risk and you're going to make $4,500, okay? That's what you're going to do. You're going to make $4,500. And I said, are you interested? And you'd say, hell yes, sign me up. If I said, you're going to win 36% of the time, you're going to lose or break even on 64% of your trades, you still interested? Maybe not. Let's take a look at month 3, okay? Month 3, remember this, important. $4,500 is what you're going to win in month 3, okay? Based on a 31% win rate. So this happens all the time. If you come into my trade room and you see this run right here, okay? Trade 224 to trade 233. That's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 trades, okay? I won 90% of my trades on average, $250, okay? On 90% of my trades, it's $250 win. That means you took all 9 trades, you came in for your trial, you saw those 9 trades and you're like, holy crap, this guy is awesome. Honey, I know, I told you I'd never do it again. I'd never fall victim to one of these trade room guys again. But God, honey, look, I'm in the simulator. I won 9 out of 10 trades. This thing is awesome, man. Honey, get to vacation. Let's look at run down to the car dealership. Let's look at the cars. This thing is awesome. And then you join and you're really excited, okay? And then based on random distribution, this occurs to you, okay? Trade 255 through trade 280. There are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 26 trades and you win 3, okay? So 26 trades and you win 3. 3 divided by 26 is a whopping 11.5%. That means I've lost 88.5%, lost or broke even on 88.5% of my trades. So after this little run here, your wife comes to the office. Honey, you've been really quiet this week. What's up? How's the oil trading group? How's the new system working out for you? Well, honey, I didn't want to tell you this, but it sucks. I got tricked again. And I got into this thing and it just sucks and he's getting clobbered. He's not nearly as good as I thought he was. And oh my gosh, right? That's how it happens. And then what do? You don't wait for the payoff to see the end of the score at the end of the game. You quit and you move on to the next thing. And that happens time and time and time again, right? You sat through all the bad stuff and you didn't wait for the payoff, right? If I told you you're going to go through a period of trades where you're going to lose 88.5% of the time, you would probably be polite by giving me the middle finger and moving on, right? At best. At worst, it might be something even uglier than that. But if I told you you're going to win $4,500 this month trading one lot, all you have to do is stay with it. What would you say? You would say, sign me up. It's the same system. It's the exact same thing, just randomly distributed out over the course of 100 trades. It's the exact same system. Remember, what I told you today, what I'm going to tell you today is going to be hard. This is some hard, excuse my language, this is some hard, well, I won't say that. This is some hard S, right? This is hard right here, okay? Everybody can trade this. That's easy. Can you trade this? Right? Can you trade that run right there? And most people can't. And so they pick up and they move on, right? And they don't get the chance to see the score of the game and they miss out on all of that cool stuff that went on in the game that you missed because you could not stick with what your statistical advantage in the market was. All right. So this all sounds great, Jason. You know, it's theory, it's random, it's you know, not in real practice, it's just whatever, it's just kind of theory. Well, and I get that a lot, and that's okay. So I'm going to throw you the link to this. Okay, this is our YouTube channel. This is my YouTube channel, and every one of these trades that I'm about to show you was taken in front of a live trading audience. Now, this is not to be confused with an actual P&L. It is just simply designed to show you that these trades exist, okay? And here it is. It's page after page of me showing you trades. Here's a 19-point ES trade. Here's an 11-point ES trade. Here's an 11-point ES trade. Here's a 109 tick CL trade. This was last week. This was a 4.5 to 1 reward to risk CL trade. This 3.5 to 1 reward to risk ES trade on the same day. This is a 71 tick CL trade with an 11 tick stop. That's 7 to 1. There's a 15.5 point ES trade on a 1 lot with a 3-point stop. That's 5 to 1. There's just page after page of this. And so what I do with these videos, actually, let me do this here. So what I do with these videos, so you can see 2 trades in the, is I go through and I will put in, okay, I'll show you, I'll talk about the market and why it was that we were getting in. By the way, here are the price ladders with the P&L that showed just in the room. This is 450, that's 710. Right? And then I go through and show you and talk about where we got in and why. And then I show you the place where we get short, right? And so this was a CL short right here, this red. 1 lot, stop was 11 ticks. And then I put some music behind it, speed it up so you can see. And then you get to see, well, here's the ES trade, right? Here was the ES re-entry on a short, right? Stop, entry, etc. Put some music, like I said, put some music behind it, speed it up. And then I show you where I get out, right? And let's see if I can go back here. Yeah, and then I show you where I get out. And so this is 771 ticks, reward to risk 7 to 1. This is a 5.2 reward to risk. This price ladder P&L will match the price ladder that you see up here on the screen when you watch the video, right? So again, I put this page together, and I put these videos together so that you can see that it is possible to do and hold on to these things that I tell you about. Remember, not easy, and you don't win every trade, and there's going to be a run where you're not winning all the time, but that reward to risk ratio, when it's in line, is the key to the entire process, right? Okay, so I told you I'm not going to sell you anything here today. I'm not looking to try to sell you on anything. I just simply am going to make you an offer to come in, register for our free trial, come in, watch us in the trade room. I can't guarantee that I'm going to win when you come in, but I can guarantee you that you're going to see this idea applied in real time in our trade room. And there is the link to the free trial to our trade room. Okay, so let me go through some of the questions here. And by the way, that's it for me today. That's all the presentation that I have. Let me try to go through some of these questions here. Let's see. Come all the way down. Yes, this is Larry. This is a live webinar. This is a live webinar here. We don't have option strategies. Let's see. Jennifer. No, that's not true. I get into the trade with an idea. So Jennifer's question, by the way, is I don't get into a trade if it doesn't have a 7 to 1 reward to risk. No, that's not what I'm saying. What I'm saying is that once I get into an opportunity, okay, and I'm going to show you this right here. While we're talking, I'm in a CL trade right here, right? I'm in a CL trade while we're talking that it's up $600, right? With an original stop of 11 ticks. I show you that to say I have an idea of where a trade is likely, probabilities are for it to go. What becomes a difficult thing, right? What becomes a difficult thing for people is that they say, well, maybe I'll take it for 2 to 1. Well, that's fine. As long as you're managing a trade at 2 to 1, 2.5 to 1, that's the examples I showed you in here today, Jennifer, is 2.5 to 1, right? If you're managing a 2 to 2.5 to 1 reward to risk ratio, you're going to be good. Paul Tudor Jones, look him up if you're not familiar with him. Hedge fund manager, basically says he goes for 5 to 1 reward to risk because he can be an imbecile 80% of the time and still be okay. That's his quote, right? So we're just looking for higher reward to risk ratio trades. I'm not looking for, you can be a scalper. You can do those kinds of things. Just understand there's a trade-off, right? I would rather be right. I know that I can be wrong a lot more than I can be right. And so when I'm right, I want to maximize it, right? There's a lot of pressure to say you have to win 70% of the time to eke out a living, right? That's a lot of pressure to say you have to be right 70% of the time. It's a lot easier for me to say I can be right 35% of the time and hold on for my bigger targets. That's easier for me psychologically. This might not be for you, not you specifically, Jennifer, but this might not be for you, right? But it's a way to look at it, right? It's just a way to look at it that is different than take one off at 10 ticks and let the other one run. And the reason people do that is because they have a psychological need to not lose, right? That's a psychological need. If you set your stop, and I have this conversation a lot, if you set your stop based on some premise in the market, swing high, maybe you're using a chandelier stop or an ATR stop or some kind of support and resistance ratio, some kind of support and resistance from a previous area. If you're using that as your premise-based stop and that premise hasn't changed, why do people take it off before it hits their target? Why? Because they're scared. There's no reason. That's a psychological feel good. That's not a reason to take a trade off. That's not a reason to do that. That's a psychological issue. And so how many times have you taken one off at break even, right? Only to have it stop you out and then turn and go your direction, right? The trading world is littered with those things, right? That happens all of the time. And so again, it's hard to do, right? And all I'm showing you is mathematically how you can make that work to your advantage if you apply that kind of idea. My average win to my average winning trade, time in trade. Let's go back here. You can kind of see it on here. So if you look here, it's about 5 to 1, right? The average is about 5 to 1. So I'm in a trade and it's not working out. I get out pretty quickly. Usually when I'm wrong, right? And it comes back, it takes me out. Very rarely am I holding on to a trade for 30 minutes and I'm in the wrong direction because my stops are fairly tight. But when it works and it begins to run, right, that's when you hold on to it, right? You try to hold on to those winning trades. Okay. What are the days, Monday through Friday, and hours of the trade room? I get in here. I'll open up the trade room at about 6:30 a.m. Central Time. I start talking at 7:45, and we generally run it into the European session close, which is about 10:30. So we're usually about 2.5, 3 hours worth of commentary on a daily basis, something like that. Let's see. Thanks. I appreciate you saying that. I'm going to mispronounce your name here, but I'm going to say it's Kershid. Thank you for the compliment. I appreciate that. That is, compliments always appreciated, right? Thank you very much. Okay, so let me go. Yeah, so Robert or Baker, it says commissions and slippage were accounted for in that spreadsheet that I showed you. They were accounted for in that. Is there an algo version, a monthly? On a Monte Carlo simulation? No, this is not Monte Carlo, and it can't be adjusted for that. It's just a pretty basic kind of algorithm that I use. Well, so Sam says this. So Sam's question is, this assumes perfect execution. Well, it really doesn't, right? So when you're talking about a 5 to 1 reward to risk ratio, okay, perfect execution in my mind, Sam, comes along when you are trying to scalp, when you got to pop, get in, pop, get in, pop, get in, right? I have a guy in our trade room that took 300 trades in a day, right? He ends up making $9,000 in a month, and one of his days he took 300 trades. That requires perfect execution, right? That requires perfect execution because his average winning trade is less than his average losing trade, right? That's his style. That's okay. That works for him. Doesn't work for me, works for him. The point I'm trying to make is this: that kind of idea requires perfect execution, right? Because if you're trying to get in and get 3 ticks, right, you got to be spot on the mouse because you may come right back against you. When you're talking about a 2.5 to 1 reward to risk ratio, does it matter if you get in at 0, or 97, 3 ticks? Not usually, right? Because the trade's going to have gone so far in your favor that those 3 ticks don't really mean much, right? It means a lot when you are trading, scalping, ticks, 2, 3 ticks off the market. That's when perfect execution really comes into play. I don't, let's say, we asked me about option strategies. Don't do that. It was live. Okay, let me come back up here into some of these other questions. Okay, so guest says he disagrees with the fact that gambling is trading. Time and trade is different, differentiator versus gambling. When the gambler tracks off seeing the win or loss, okay, that's gambling in my opinion. Yeah, and that's fine. I think we're talking semantics. All I'm doing is breaking this down. When I said trading is gambling, I'm breaking it down to, I'm stripping all the paint off the card and we're breaking it down to the bare metal, right? At the end of the day, it's a coin flip, in my opinion. When you get into a trade, regardless of the win percentage, unless it is a 100% guarantee to win, you're gambling, right? Because there's only 2 things that can happen. It can either win or it can lose. There is nothing else that can happen on that trade. Even if you break even on the trade, you're still paying commission and maybe slippage. So that's a loss. So there's only 2 things that can happen. It's either going to win or it's going to lose. And if you have a trading system that wins 80% of the time, how do you know if you're in that 20% that wins? How do you know? You don't. Or that 20% rather that loses. So in 100 trades, 80 of them are going to win and 20 of them are going to lose. The moment you enter into that trade, you could be in that 20 that lose, right? You could be. And if you don't have good reward to risk ratio, you could statistically possible take 20 losing trades in a row before you get to the 80. That's why I call it gambling. You're right. We may not agree on that point, but that's kind of the way I look at it from that perspective. So hopefully that makes sense. Okay. But again, if I said to you, hey, I have the, okay, let's do it this way. I don't know if you guys ever watched Ozark. There was a really good point that was made. If you watched Ozark, they run a casino. And on any given hand in the casino, blackjack cards, pull of the wheel, the casino is gambling with you, right? They are gambling with you. They don't know if it's going to win or not going to win. They are gambling with you, right? It's only when the numbers get in, the number of trades and the number of people, does that statistical advantage start to bear out over time. But on a one-to-one basis, you're gambling and the casino is gambling. They're gambling with you, right? But what we try to do and what you want to try to do is you want to try to turn those odds into your favor. Now, those odds can either be a high win percentage with a low reward or a low win percentage with a high reward rate. Those are your 2 choices when it comes to trading. Now, there is that one sliver of the pie where you could say, man, I have a 4 to 1 reward to risk ratio and I win 60% of the time. Well, you've got a goose that lays the golden eggs, and I hope the market doesn't change, and I hope it goes that way forever. But generally speaking, if you are going to have a high win rate, your dollar per win is going to be low. If you have a high or low winning percentage because you're holding on for bigger targets, then you can have the ability to have a high. Now we're assuming that the system works, but you're going to have the ability to have a higher dollar per item than you do when you have that lower dollar per item on a higher win rate. Hopefully that makes sense. I think I may have just confused you, but maybe not. Yeah. Hey Jeff, it's good to see you. Thanks for the email today. I appreciate that. Yeah, that's it. I mean, Khurshid, that's hopefully I'm saying your. So Khurshid says high win rate is usually a low win dollar percentage, and it is, right? Because you get out quicker. I can have a very high win percentage, but my reward to risk ratio would be lower. And again, it's a choice. My choice is I'd rather say that I would rather be right less and know that I'm going to be okay, right? Because I know that the market changes. Think of the room that you have if the market's going to change on you, right? And your win percentage in that one of these scenarios, a 62% scenario where you made $1,000 in 3 months, your 62% win rate. What if that drops to 55%? That's still a decent win rate, but because your reward to risk is so far out of line, you're losing money on a 55% win rate, right? So if you have a lower opportunity, a lower win percentage, right, and a higher reward to risk ratio, there's more room for error in that kind of number. Personally, for me, that makes me feel comfortable. If that's not for you, that's okay. You just know what your numbers are and how they affect what you do. That's all. Just know what they are and how they affect it. Ah, very cool, Krishit. All right. So if that's it, I think I don't see any more questions in here. Let me just say thank you so much for oh, Jeff had a question. Okay, very good. Yeah, Jeff was in our free trial room and he had a good couple of days while he was in there. Yeah, Jeff, like I said, I appreciate you. We're looking forward to having to become a member. Larry, come in tomorrow. Again, I'm trying to keep this particular discussion separate. It is way less than you might think. Let me just put it that way. Come in tomorrow, Larry, take a look around, and one of our guys will chat with you about it. I don't want this to be a sales type idea today. You get 3 days, Jennifer. You get 3 days. So just register. We'll talk to you about that stuff when you come in here, when you join us for your trial. So again, like I said, I just want to say thank you for stopping in today. I really appreciate you being in here with us. Hopefully you learned something. That was my objective today, is to hopefully get you to learn something, a different idea, if nothing else, right? And so, like I said, I don't want this to be a sales pitch or any of that kind of stuff. And I just want you to walk away with what I hope is some good information for you. So unless there are other questions, I think we're done. Again, thanks very much for joining us in here today. I certainly appreciate your time. And without further ado, that is it for me here today. You guys take care and thank you.